How do real estate investment trusts make money? What if I told you you could own a piece of some of the biggest shopping malls, office towers, and apartment complexes in the world without ever buying a single building? Sounds impossible, right? But that's exactly what millions of investors do every single day through something called Real Estate Investment Trust, or REIT for short. From skyscrapers in New York to warehouses in Dubai, REITs quietly control trillions of dollars worth of real estate globally. Yet, most people have no idea how they actually make money, or how they pay out steady cash dividends year after year. Today, we're diving into the fascinating world of REITs, how they work, how they generate profits, and why they've become one of the most popular ways for everyday people to build wealth through real estate. So, if you've ever dreamed of being a real estate mogul without the stress of tenants, toilets, or taxes, you're about to learn how it's possible. Let's get started. Imagine this. Instead of saving up for years to buy a single rental property, you could invest a small amount of money and instantly become part owner of hundreds of properties. Shopping malls, hospitals, hotels, apartment complexes, even data centers that power the internet. All of them generating income every single day. That's the magic of a REIT. A REIT is essentially a company that owns, operates, or finances income-producing real estate. Think of it like a mutual fund, but instead of holding stocks or bonds, it holds buildings, the kind that make money through rent. When you buy a share of an REIT, you're not just investing in one property. You're buying a small slice of all the properties that REIT owns. So, if it holds 50 office towers across the country, you technically own a fraction of every single one of them. Here's where it gets interesting. Every time those buildings earn money, whether it's from tenants paying rent or hotels hosting guests, that income flows into the REIT. And by law, those companies have to pay out at least 90% of their taxable income to shareholders in the form of dividends. That's a huge deal because it means REITs are designed to pass profits directly to investors instead of keeping them locked inside the company. There are a few different kinds of REITs out there. Some own and manage physical properties like apartments, malls, and office buildings. These are known as equity REITs. Others don't own buildings at all, but instead lend money to property owners and developers, earning interest from those loans. These are called mortgage REITs. And then there are hybrid REITs that do a bit of both. So whether it's a skyscraper in New York, a warehouse in Dubai, or a suburban shopping center in Texas, REITs allow ordinary investors to get a slice of the real estate market without needing millions of dollars or years of property management experience. You could start with as little as $100 and still be part of some of the biggest and most profitable properties in the world. It's like being a landlord, but without the stress, the tenants, or the maintenance calls at 2 a.m. To really understand how real estate investment trusts make money, we have to rewind the clock back to the late 1950s when real estate was a playground only for the rich. Back then, if you wanted to invest in a shopping mall or an office building, you needed deep pockets, powerful connections, and, usually, a team of lawyers. Ordinary investors didn't stand a chance. But in 1960, something remarkable happened. The US Congress passed a law that completely changed the real estate game. It was called the Real Estate Investment Trust Act, and it was tucked inside the cigar excise tax extension of that year. A rather unexpected place for one of the most transformative investment ideas in history. The goal was simple: to give average Americans the chance to invest in large-scale, income-producing real estate, just like wealthy institutions and corporations could. For decades, only the elite could afford to own skyscrapers or entire apartment complexes, but this new law opened the door for everyone by allowing companies to pool money from thousands of investors and use it to buy and manage real estate. In return, these investors would earn dividends from the rent and profits of those properties generated. It was a win-win system. The first REIT started small, mostly focused on mortgages and income-producing properties like warehouses and office parks. But as the years went by, the concept exploded. By the 1990s, REITs had become a mainstream investment option, listed on major stock exchanges and traded just like regular stocks. That made real estate investing as simple as buying shares of Apple or Tesla. Today, the REIT industry has grown into a multi-trillion-dollar global market, with hundreds of companies owning millions of properties worldwide. From hospitals and data centers to self-storage units and luxury resorts, REITs have become a backbone of the modern economy. And the beauty of it all? It started with a simple idea that real estate shouldn't be a privilege reserved for the wealthy, but a source of wealth accessible to everyone. Now that we know what REITs are and how they started, let's talk about the big question. How do they actually make money? Because behind every skyscraper and apartment complex, there's a powerful business model quietly generating cash every single month. At its core, an REIT makes money in four main ways: through rent, property value growth, interest, and management fees. But let's not just list them. Let's walk through what this looks like in real life. Imagine a REIT that owns a chain of luxury apartments across major cities. Every month, tenants pay rent, and that rent doesn't just vanish into a landlord's pocket. It flows directly into the REIT's income pool. The company then uses that money to cover maintenance, management, and taxes. Whatever's left, the net income, is distributed to investors as dividends. That's the bread and butter of REIT profits: steady rental income from real physical properties. But rent isn't the only source of profit. Over time, the properties an REIT owns can increase in value, just like your home might appreciate over years. When a REIT decides to sell one of its buildings, it can make a hefty profit from the capital appreciation, and that gain can boost shareholder returns or be reinvested into newer, more profitable properties. Then there's the world of mortgage REITs, which play a slightly different game. Instead of owning real estate directly, they lend money to property owners or buy mortgage-backed securities. Every month, they earn interest on those loans. It's like being the bank, except instead of charging you interest on your mortgage, they're collecting it and passing a portion of it back to their investors. Some REITs also generate income by managing properties for others. Think of big hotel chains or retail groups that don't own every building they operate in. A REIT might own the property while the brand manages the business. The REIT earns management and development fees, or even a percentage of profits from these partnerships. It's a smart way to make money without adding new buildings to the portfolio. And here's what makes the REIT model so appealing. By law, these companies must pay out at least 90% of their taxable income as dividends to shareholders. That means REITs are constantly channeling their earnings back to investors instead of hoarding them. It's one of the few investment vehicles where the cash flow never stops moving. So whether it's the rent from a luxury apartment, interest from a commercial loan, or profits from managing a resort, REITs have multiple streams of income flowing in. That's how they keep growing, even during uncertain times. Let's step away from theory for a moment and look at what this looks like in the real world. Because some of the biggest REITs on the planet are companies you've probably interacted with without even realizing it. Take Simon Property Group, for example.
Simon, the biggest mall owner in the country.
You might not recognize the name right away, but if you've ever walked into a massive shopping mall in the US, there's a good chance it was owned by them. Simon is one of the largest retail REITs in the world, with properties across North America, Europe, and Asia. Every store that rents space in one of their malls, from Apple to Zara, pays rent directly to Simon. Multiply that across hundreds of malls, and you can start to imagine the cash flow. In 2023 alone, Simon Property Group generated over $5.6 billion in revenue, with a large portion distributed back to investors through dividends. Then there's Public Storage, the orange and white self-storage company you've probably driven past 100 times. What started as a simple idea, renting out unused storage units, has turned into a real estate empire. Public Storage owns thousands of facilities across the US, renting units to millions of people who need extra space for their stuff. The company earns steady income month after month because people rarely give up their storage units quickly. That's recurring revenue on autopilot. In 2024, public storage brought in nearly $5 billion in annual revenue, proving that even small spaces can create massive profits. And let's not forget Prologis, a REIT that focuses on industrial and logistics real estate, basically the warehouses and distribution centers that power global e-commerce. Every time you order from Amazon, there's a chance your package passed through a Prologis-owned facility. As online shopping exploded, so did their profits. Today, Prologis manages more than 1.2 billion square feet of industrial space across 19 countries. In other words, they're the invisible landlords of the internet age. These companies show how powerful the REIT model can be. Whether it's luxury malls, simple storage units, or massive warehouses, they all follow the same formula. Buy income-producing real estate, rent it out, collect cash, and share the profits with investors. The key difference lies in the type of property they focus on. Retail REITs earn money from tenants like clothing brands and restaurants. Industrial REITs profit from companies like Amazon and FedEx. Residential REITs collect rent from apartment tenants, while hospitality REITs earn income from hotels and resorts. But no matter the niche, the principle remains the same. Turn space into steady cash flow. And thanks to how REITs are structured, ordinary investors can buy shares in any of these billion-dollar companies and get a piece of that income stream. So, how can you actually invest in a REIT? How do regular people without millions of dollars or real estate licenses become part owners of billion-dollar properties? The answer is surprisingly simple. You don't need to call a realtor or tour a building. In fact, you don't even need to leave your couch. Most REITs are publicly traded on major stock exchanges, like the NYSE or NASDAQ, just like companies such as Apple or Coca-Cola. That means you can buy shares of a REIT through any regular brokerage account, platforms like Robinhood, Fidelity, or Charles Schwab, and instantly own a piece of income-producing real estate. Let's say you buy shares of Prologis, PLD, the warehouse REIT we talked about earlier. When those massive fulfillment centers collect rent from companies like Amazon or DHL, part of that income eventually makes its way to you in the form of dividend payments, typically every quarter. It's like collecting rent checks, but through your brokerage account. Now, not all REITs are publicly traded. Some are private or non-traded, meaning they're only available through specific investment firms or funds. These can sometimes offer higher returns, but also come with less liquidity. You can't just sell your shares whenever you want, like you can with a public REIT. That's why most beginners stick to the publicly traded ones. They're transparent, regulated by the SEC, and easy to buy or sell anytime. Another simple way to get exposure to REITs is through REIT ETFs, exchange-traded funds that bundle multiple REITs into one single investment. For example, the Vanguard Real Estate ETF, VNQ, holds dozens of REITs across various sectors, from commercial to industrial, giving you instant diversification. Instead of choosing individual REITs, you get a little piece of all of them, kind of like owning a slice of the entire real estate market. Investing into these trusts means you can earn passive income consistently, whether the market is booming or not. Many investors even reinvest those dividends to grow their portfolio over time, a strategy known as dividend compounding. Over the years, that can lead to serious long-term growth. So, with just a few clicks, you can go from a regular investor to a silent landlord of shopping malls, office towers, and warehouses around the world. No tenants, no maintenance calls, no closing costs, just real estate income flowing straight to your account. By now, REITs might sound like the perfect investment. Steady income, low effort, and access to some of the biggest real estate portfolios in the world. But like every money-making opportunity, there's always another side to the story. Let's start with the biggest one, market volatility. Even though REITs are backed by real assets like buildings and land, their prices still move up and down just like regular stocks. When the overall market drops or interest rates rise, REIT shares can fall too. That's because higher interest rates make borrowing money more expensive, and real estate companies often rely on loans to grow. So when rates go up, REIT profits can take a hit, and investors may pull back. Then there's dividend sensitivity. Many people love REITs because of their high dividend payouts, but those dividends aren't guaranteed. If a REIT's rental income drops, say during an economic slowdown or if tenants leave, the company might have to reduce its dividend. It doesn't happen often with strong REITs, but it's possible. Another risk is sector concentration. Not all REITs perform the same way. For instance, retail REITs that own shopping malls struggled during the pandemic when stores shut down and foot traffic disappeared. On the other hand, industrial REITs like Prologis thrived because online shopping skyrocketed. So, choosing the right type of REIT really matters. If you put all your money in one sector, a sudden downturn could hurt your portfolio. And here's a common misconception. Some people think investing in REITs means you'll always get consistent profits no matter what. But that's not true. Real estate markets go through cycles, and REITs are no exception. There are times when property values stagnate or when rental demand dips. Even though REITs can smooth out short-term fluctuations with diversification, they're still tied to the broader economy. However, not all risks are necessarily bad. For example, leverage, or using borrowed money, can amplify returns when things go well, but it can also magnify losses if markets turn south. That's why experienced investors often research an REIT's debt-to-equity ratio before investing. A company that's too leveraged may look profitable during good times, but vulnerable during downturns. The key takeaway? REITs are a powerful wealth-building tool, but they're not a get-rich-quick scheme. They're best suited for investors who want steady, long-term income and can handle some short-term ups and downs along the way. If you think of them as a marathon rather than a sprint, you'll appreciate the consistency they bring to a diversified portfolio. If there's one thing we've learned today, it's that you don't need to be a millionaire or a property tycoon to profit from real estate. The world of REITs has made it possible for everyday investors to build wealth from some of the biggest, most profitable properties on the planet, without ever picking up a hammer, negotiating with tenants, or worrying about maintenance costs. Real estate investment trusts have transformed the way people think about real estate ownership. They've turned one of the most exclusive wealth-building opportunities into something accessible, transparent, and surprisingly simple. Whether it's a massive shopping mall in Chicago, a data center in Singapore, or a warehouse in Germany, you can literally own a fraction of it with just a few taps on your phone. But, as we've seen, REITs aren't magic. They're not immune to market swings or economic slowdowns. Their power lies in their consistency, and the ability to generate passive income over the long haul. When you invest in an REIT, you're not just betting on one property or one company. You're investing in a system that's built to share wealth across millions of investors. And that's the beauty of it. REITs take the most tangible form of wealth, real estate, and make it liquid, accessible, and global. They've democratized property ownership, giving everyone from a college student with a few dollars to a retiree with a lifetime of savings a chance to earn from real estate without ever signing a lease or managing a tenant. So, the next time you walk into a mall, stay at a hotel, or order something online, remember, behind those walls, somewhere, a REIT is collecting rent. And with just a small investment, you could be one of the people sharing in that profit. If you found this video helpful, hit the like button, subscribe, and turn on notifications, because in the next episode, we're breaking down how REIT dividends compare to rental income from owning property yourself. You won't want to miss it. Thanks for watching, and remember, you don't need to own the building to earn from it. You just need to understand how the system works.